Hi, I'm Jarrad Brown, Australian expat financial planner based here in Singapore. Welcome to my video series. Today we're going to talk about a much widely discussed topic, and that is the interest rate rise that we've just seen in Australia. It's the first interest rate rise that we've seen in 10 years. There is a whopping 1.5 million Australian homeowners that have never experienced a rate rise. So in this video, we're going to discuss what the forecasts look like for interest rates in Australia, what that's going to mean for homeowners and property investors, and finally, what you should consider if you have either investment debt or a mortgage on your own home in Australia. So let's dive right in. Now, the cash rate in Australia has been sitting at 0.1%, but was just lifted in May prior to the Australian federal election by 0.25 and now sits at 0.35. Expectations are that we'll see a 0.15% increase in June, and that'll take the cash rate to 0.5%. We've already seen the major banks in Australia and many of the other lenders, other banks in Australia, pass on that variable rate increase to their borrowers, and most people are expecting that we'll see that cash rate sit between 1 to 1.8% by the end of this calendar year. Now, that's going to mean a pretty significant jump for a lot of homeowners and those with mortgages or investment debt who may have been paying a mortgage starting with a 1 or a 2 as a percentage rate, and investors paying something between about 2 and 3%. Those rates are already ramping up, particularly fixed rates. We're seeing many fixed rates sit between about 3 and 4.5% now. But as the cash rate increases, we're going to see those rates significantly higher. Most economists, most banks are forecasting that we'll see the cash rate by the end of 2023 sit between 2 and 3%. That's a whopping increase from where we are now, and that's going to mean for a lot of households they're paying a significantly higher interest rate. So what can we do? What can you do if you have a mortgage on your own home, or if you have investment debt? Let's have a look at some of your options. So the first thing you can do is that if you have a variable rate on your mortgage, or if you're coming off a fixed rate, meaning that the fixed rate is expiring, you may want to consider utilizing an offset account. That allows you to hold cash in the bank, and for every dollar that you hold in that bank account, that's $1 less of your mortgage that you pay interest on. So it could mean that you can reduce your payments if you have an interest-only mortgage. It could mean that you're repaying it faster, or it could just mean that you can get rid of that debt in a different way and keep your cash accessible. Now, with offset accounts, there are some tax implications, particularly on the positive side, so I would definitely recommend speak to your financial planner, speak to your accountant, and make sure that it's right for you. Your second option that you've got to explore is to consider refinancing either to a different lender or requesting a discount with your current lender if you can. Rates are going to increase. We've already seen over the last 2 months, fixed rates increase quite considerably, particularly amongst the major banks. We've seen around 6 to 7 increases quite consistently over the last 2 months, and no doubt those rates are going to continue to climb. So review your options. There are many lenders in Australia to consider. Whether you're an expat or you're an Australian resident, there are plenty of options for you to have a look at, so make sure you explore your options. The third option you've got is to consider changing the frequency of your repayments. Now, for a lot of Australians living in Singapore, we often think on a monthly basis. We pay our rent each month, we get paid each month, and everything just seems to happen on that monthly frequency. So for a lot of people, we pay our Australian mortgage, our Australian debt, on a monthly basis as well, just because it tends to make sense. However, if you find that you can increase that frequency to either fortnightly or weekly, you may find that you're paying off less interest and you can pay off that debt a little bit faster. So certainly something to consider there. And finally, my final tip for you to consider, or final consideration for you to think about, is to consider the overall structure of your loan. You may want to think about a split structure between fixed and variable with an offset account. There are lots of options. Again, whether you're an expat or you're a resident, you still have access to these options. So make sure you speak to your mortgage broker, speak to your accountant, and make sure that the loans are suitable for you. We've got a lot of inflationary pressure in Australia at the moment, particularly with what's going on between Russia and Ukraine. Naturally, that's driving commodity prices higher, oil prices higher, but we don't expect that these inflationary pressures are going to be here to stay. So make sure you do your homework, consider what your interest rates look like, and don't simply bury your head in the sand. If you have any questions about your debt, around what your strategy should look like with your mortgage, with your investment debt, feel free to drop me a note, drop me any questions you have in the comments section. Thank you very much for tuning in. I look forward to seeing you next time.